everyone who's waiting, thank you for waiting. We've had a few technical difficulties we had to overcome. But we're good. We're good now. Thanks for waiting. I appreciate it.
That's mostly my fault.
You didn't have to take that punch on the chin. Yeah, it's complicated. We're connecting all these different streams through 2 different servers and then 4 different locations. But we're good now. We're good.
Right. So ready to go. So I will start it off.
Yes, sir.
Welcome, everyone, to the Cardano Effect Podcast, episode 98. The purpose of this podcast is to take high-level developer information and projects that are occurring within the Cardano space and break them down into bite-sized, consumable pieces of information for everyday use. I'm your host, Philippe, and let's get this podcast started. Rick and myself are the host of the Cardano Effect Podcast, and this is our weekly live stream series. If you're not familiar, this is where we recap all the news and events that happen within the Cardano ecosystem for this past week. We also talk about blockchain in general. So without further ado, we have a couple guests on today, so we want to get right into the mix of things. I have a few announcements before we get into the meat and gravy of this podcast episode, but once again, I want to remind everyone that none of what we say on this podcast is financial advice. Remember, you are your best financial advisor, and if you don't think you are, you need to find someone who's qualified to do so. Rick, how are you doing this Sunday morning? What's going on? What's happening?
Hey, I'm doing great. Thanks for asking. I'd like to give a shout out to the Cardano Foundation for sponsoring this podcast. Thank you all very much for your support. And I'd like to remind any viewers new to this podcast is available on all audio streaming platforms. So Google Play, iTunes, everything, Deezer, Spotify, iHeart, everything. All right, so I would like to thank our guests. Returning to the Cardano Effect, we have financial professional Umed Saidoff and cybersecurity professional James Kelly are back with us today. Gentlemen, thanks for coming back. I appreciate it. Thank you all. We got two big topics today. The first one we're going to hit on is stake delegation and how does that work and the pledge percent with Umed Saidoff. Both of you requested to come back, by a large majority. A lot of people are like, hey, we want people like this coming back on the program. So we're going to start off with Umed. We'll talk about the stake delegation percentage and how does that work now that we know more about it. We had previous episodes where we kind of understood it, but now it's a little more refined. Umed, thanks for coming back. How you doing?
Thank you so much. Thank you again for having me here. It's a pleasure always to talk to you all, guys.
Umed, I'm just going to briefly jump in real quick. I just have a couple of announcements to make right before we start this. Yep. So I just want to make sure. Right. Thank you to the Cardano Foundation for sponsoring this podcast. And I have a few announcements to make from the community before we start talking about stake delegation rewards and scam reports. The first one being is that the Cardano Times just released. And the Cardano Times, if you are familiar with one of Charles's recent videos on his YouTube channel, I think it was a couple weeks ago, he was talking about the Bitcoin magazine, and basically it's the end of the Bitcoin magazine. Now it's the Cardano magazine, and you can go to cardanotimes.com and you can follow Cardano Times also on Twitter. There are a few different authors who are authoring articles. It's a great start. You can find articles there. There's a price tracker. There's also a GitHub development tracker. You can find Cardano-related videos from YouTube, so it streams all these Cardano YouTubers. It amalgamates it onto one page. There also is a Twitter feed and a Cardano news feed, so you can go ahead and follow Cardano Times on Twitter and go to cardanotimes.com to check out the digital magazine. The next announcement that I have is an RFP, a request for proposal, and this is from the Cardano Foundation. So recently, their last RFP, it was the Stake Pool Dashboard RFP. So this is where the Cardano Foundation awarded $1,000 a month for 3 months to 5 different pools, those being ADA Pools, ADA Stat, Your Manager, Pegasus, and Pool Tool. Their next RFP is open, and it is tailored towards Goguen and smart contracts. They are looking for groups, companies, and individuals to use other programming languages in addition to Haskell to write dApps. So this is all about Plutus. So the main language is Haskell. We are looking for other developers proficient in different languages to submit an RFP, and you will get funding from the Cardano Foundation. And this is all going to speed up the process and helping people that are developing on different platforms port their dApps over to Cardano, whether that be you're working with Solidity and Ethereum, or you're developing dApps within Cosmos. All these different apps, all these different blockchain projects are going to have that access to the Cardano blockchain. Also, the foundation is hiring a digital marketing specialist and a technical project manager. We receive a lot of information about people that are not necessarily developers that want to work within the Cardano Foundation, Emergo, IOHK. You can always visit their job portal. And the last piece of news is from Uphold. Uphold recently added ADA, so now you can buy, sell, and trade ADA. They serve over 184 countries with 30 different currencies. They're very US friendly, so I think this was a great addition, and great job to the Cardano Foundation for all these news and events, and you can go ahead and follow them on Twitter as well to stay up to date with everything. So Rick, I'll pass it back over to you, and we can get right into the mix of things.
I was glad to hear all those stake pool dashboards won some award, got some award. That's fantastic news. That's great news. And a shout out to Pegasus app and the work on that. I think that app has a lot of potential to go a long way in addition to all the other monitoring tools, ADA pools and pool tools. So well done, guys. Well deserved. And congratulations to all of you who have already won those awards. I appreciate it. Let's roll back over to Umed Saidov, where we're talking about the pledge stake percent. Let's say I'm a delegator. I have a certain amount of ADA, and I'm going to delegate it to a pool. What should I be looking for?
Yeah. So again, thanks for having me here. I think a couple of weeks ago, the IOHK has released a list of all the systemic parameters for the protocol, which was an exciting sort of time because we kind of narrowed down the range of possible outcomes for each delegator and calculate all these things. And the most important one of them is a rho, which is at the rate at which the reserves get depleted. It's 0.22% per epoch, and it dictates the emission policy of Cardano. And once we know that, we know how much money there will be, ADA will be issued for the foreseeable future. And then we can calculate everything else based on, other parameters that are out. The other important parameters that were out were the level of tax, which was the treasury tax, 5%, the K, which is the number of pools, optimal pools. I created a spreadsheet and wrote a post on the Reddit that was very well received about my findings. And the purpose of this podcast, coming to the podcast, is actually to walk the delegators through the decision-making process, because one of the things that every delegator and rightly so they look for is returns, right? Returns on staking, and that's by design is supposed to be that way. So every delegator looks for the most returns, but there are offerings in the market, and that's kind of disconcerting a little bit to me, at least, that they might be offering a lot of returns, but they might not necessarily, the delegators may not understand the repercussions of risks that they may be taking. I'm talking about exchanges, to be honest with you. And to illustrate that point, I could share my spreadsheet and we can go through that if you guys are up for it.
That would be great.
All right.
What do you think?
Yes, let's go for it.
I'm looking forward to it.
Disable participant screen sharing, it says.
Mm-hmm. So let me see if I can enable that or if I need to enable it. And Zoom has improved security, although it's still a little bit room to grow.
Okay.
Can you screen share if you hit that green button bottom center?
Nope.
Yep. Nope.
Nope.
Okay, I'm going to make you a co-host.
All right.
Okay. Now that should enable.
I can do that now. Yep.
Yay.
All right. So I have a spreadsheet here. You guys see it well? Do I need to zoom it in?
I see it well.
It looks good.
Okay. So
let me know in the chat.
If you guys see it, then we're good to go. What I want to do is I want to give you guys an option. Have everybody on the whoever is listening, we can go through some options here.
Looks good.
So you have, as delegator, 3 options in front of you, right? One is option A. The pool says I'm going to give you 6.5 percent per annum. Option B says 4.7 after deducting my fees and everything. And pool option C, it says 4.32. It's like basically calculated expected return on staking. These things can be calculated. Fees, you can see, the first pool says, I don't want to charge you any fees. The second pool says 5% percent fees, and the third it says 1% fee. And a very, very simple sort of, I would like to know, like, what option would your audience choose? I mean, would that be A, B, or C?
That's a good question. So let me know in the chat what you take. Initial look here, option A, option B, option C. Just punch it in the chat right quick and let us know what you think. All right, Umed, what do you think? What do you got for us?
All right. No, I mean, not knowing anything else, that's a rational thing to do, right?
Yeah.
You basically, go for the highest, right?
You're going to look at the ROS.
Yeah, the IRS. But as often happens in the financial world, there's no return without risks, right? And the Russians have this saying that if you want the free cheese, you will find it in the mousetrap, right? So now let me give you another piece of information, and that is chance of hacks per year. By the way, the first option is exchange. So I've done a very rough calculation that, at any year, an exchange has a 4% chance of getting hit. And if that happens and you lose all your money, then your risk adjusted return is not 7, it's 2.33. And then risk adjusted return for the pool A, pool B is 4.47, and then pool C is 4.28. As you can see, when you adjust for risk, things drastically change. And that's something that I wanted to kind of drive home because, no matter what kind of offers you get, when you give up your keys, you are exposing yourself. And I'm sure James will agree, you're exposing yourself to hacks on systems that are really hack prone. And I'm not basically taking all this, from anywhere. I've looked at the history of hacks. From June 2011 to October 2018, there were hacks that totaled $11 billion worth of cryptocurrency. They got lost, right? Got stolen. So this risk is not, it's real. And in 2019 alone, there's a source on Cointelegraph, there were 12 hacks on exchanges. And I calculated on CoinMarketCap how many exchanges are there. And I took everything, right? Except for the ones that are not really active. And there are 288. So if you divide 12 by 288, you get 4.117. So, if you take this, and the instance of hacks is growing, and probably has to do something with the fact that the list of exchanges are growing too. But if we take this data point as some indication of exchanges getting hacked and you losing your money, then you have 4% chance of losing all of it, and you get 2.33% adjusted risk return. So when you do calculations like that, when you take into considerations the losses of principal as a result of picking an option with a higher yield, your expected return is low. And that's how we operate in the financial market, because we not only look at the returns, we also say, okay, well, there is a higher return, but it usually entails higher risk, and let's understand those risks and be comfortable. Look, if you're comfortable with taking that risk, it's your individual choice. I just want to drive this point home that if you stake with an exchange, you're exposing yourself, and that's not something that, it might get hit and it might not. I mean, there's a mathematical way of calculating your expected returns, and that's basically 2.33 versus 4.47, for instance, in this particular case. So that's basically my first point that I would like to get across. In terms of how much we are going to generate systemically, I've calculated this schedule over here. So the row, as I was saying, the rate of the rate of decay is 0.22% per epoch, and this is basically the schedule of rewards. For the first year, we're gonna issue about 2 billion ADA for distribution, and that equals about 6.37% on the total available supply of 31.5 billion circulating right now. So the total possible return for anybody is 6.37. So if somebody says, I'm going to give you 8, you got to ask yourself, why is there an 8 in there? Why are they going to just subsidize us? So if everything was set to 0 and they gave you the taxes back, and that would be the number that they would be giving you. But the realistic maximum possible return in this under this scenario is 6.07, and that's basically the pool that's maximum at maximum capacity at maximum pledge, as you will see in my calculations here. Does that make sense? I'm happy to take questions as we go.
No, that does make sense. I was running. I was running the pledge calculator yesterday. The staking calculator from Lars Bunez.
Mm-hmm.
He did the video on it, and then I just followed the video and I followed the calculator. And I started dialing in the numbers. Now I have more realistic numbers because I had dialed in 1 million ADA per epoch. But I like your calculations better. It's going to be a little bit more accurate. And I was also pleasantly surprised by the results, because the pledge calculator that Lars puts out shows you the returns at the end of the year. So it kind of, in my assessment, it compounds the interest. And I was pleasantly surprised with what I saw. So that 6.07% is that's an annualized percent or per epoch percent?
Yeah, it's annual. This is basically what you will get at the end of the year, and that's basically what I do with my calculations. I don't annualize them. I just basically say we have 2 billion for this 1 year, and you divide them by the number of ADA that's available through the reward calculation formula, and that spits out a percentage. That's my way of doing it. Lars Bunez has compounded his, to be honest with you. Maybe that's why he's getting a little bit higher, maybe.
Yeah.
But my point is that you cannot have more than is available by row. And I think compounding it gets you there, that way. But my sense is that, if there is there a share rewards? I had a small calculation here. I'm not going to go through that. That's kind of too complicated. But yeah, let's just go to the first table here. You will see that on the top part, we have the amount of pledge a pool could have, and then there's a pool size. And then I calculate the amount of the percentage returns after the tax for the pool, but before the fees, just to give you a sense of like what the range of returns we could expect after the tax, after the treasury tax. And that's basically on a systemic level, right? Because we don't know what each pool is going to charge, it's really difficult to basically give you a net return, because that net return depends on your pool. But regardless, you can see that at a minimum, you should be on an aggregate basis again, right? The minimum return is going to be 465, maximum return is going to be 605. And that's the effect of something called A0. A0, for those of you who don't know, is the a parameter that sort of gives a boost to those pools who put larger and larger amount of pledge to their in their pools, to sort of juice up the returns. But the returns could never exceed the 6.05 per year in my calculations, at least. That's the message in there. Now, in terms of annual delegation returns, basically, right? That's if you're delegating with a pool that is charging, let's say, 5%, smaller pools basically, because we have something called the fixed cost for each pool. Smaller pools will take a larger and larger portion of those rewards. But as they grow, the returns really accelerate really fast. So for instance, if the pool is 2 million, your return is 3.24. And if the pool goes to, let's say, 6 million or 10 million, which is very easily doable at K150, then you basically are, in a clear, in a sense that, those fixed costs get distributed over a larger amount of ADA. Therefore, your individual return is going to get higher really fast because they are fixed. So that's the second sort of table here. The third one is the delegator costs, right? So if I'm delegating, I would like to know what percentage of my returns is a pool eating, right? So here in this table, I'm showing on the top part you have your variable fees, and on the column here you have the pool size, and if you are staking with a 1% pool and the pool is 2 million ADA large, the difference between the 1% pool and a 5% pool is negligible. It's 1.41 versus 1.28. They will be still eating a lot of sort of the rewards because that there's a fixed fee. But as you get to a larger sort of more realistic size pools, right? So it's a 5, 9, 19, for instance, right? Then you get into an extremely small sort of differences here, right? So the difference in the cost that you pay per annum, right? It's the cost that you pay for the entire year is going to be 0.18%. So you're paying 0.18% more to a pool with 5% fee than to a pool with a 1% fee. So just to give you an idea of the scale, it's not that the 5% pool takes 5% of your returns of the total returns. So it takes a fraction of that return. So if your return is, let's say, 4.5, your actual cost is supposed to be that times 5%. Oh, this is to be percentage. Yeah, so it's 23%. I mean, sorry, 0.23%. You are paying. As I was saying in my tweet earlier this week, if you're in crypto, your daily fluctuation is 5%, 3%. This amount that you're paying for pool operators is a minuscule amount compared to what you're experiencing on a daily basis. That's the point I wanted to also drive home, because it's an important one, and the viewers and the delegators need to know that we're not taking if their returns is 4.5, we're not taking the whole 4.5 out of them. It's just a fraction of that. So those are basically the two messages I wanted to convey with this. But I'm happy to answer any other questions you guys have.
Umed, can we look at this chart for a moment? As people think of what their questions are, I also have one as you were going along. Okay.
Yep.
All right. So you see on the left-hand side of the left column, if you go down to 146 million to 167 million, those two bands, 146 to 167.
Yes.
when I was playing with the parameters yesterday using Lars's spreadsheet and between 1 and 5%, for example, and I was using those as example, for some reason that range of numbers came up when I used A0 equals 0.3 and K equals 150 and other parameters that I dialed in, and the saturation range was somewhere around there. Maybe it was at 175 million. I did another parameter, came out at like 200 million. But I started to find what I call happy numbers around that 146 to 167 range, which is really, really high. Like, that's a really good pool if you're hitting that number. Then what I found was when I looked at pools between 1% and 5%, as the pool charging that as the margin, there wasn't a lot of difference. I'm also seeing that on your spreadsheet here. Where I found the biggest difference is in the pool cost, where I would dial in a pool cost of like 50, which is unrealistically low, and then I would dial in a cost of 500, which was higher, to try to look at it through the eyes of a delegator and try to find what does a good pool look like. And as I ran those numbers, what I found is the percent, the percent margin was not as impactful as the pool cost. Does that seem to concur with this sheet, or maybe I used the calculator wrong? But it looks like there's some parallels between what I did yesterday and what you're showing us now.
Yeah, I mean, we can go through that example, to be honest with you. But just a caveat here is that we cannot lower the pool cost, fixed cost lower than 340, which is what I've basically indicated here. But if we do 50, for instance, right? We will see a boost in returns. So this is the annual delegator returns, for instance. We should see a big boost.
You know what I also noticed? Yeah. That's pretty good. So if you hit 50, then if you try 500, you'll see you should see a significant drop. What's it say at 500, for example? You got to enter tab. It updated.
I did. I just takes a while because this spreadsheet calculates a lot. So
look at the difference. It dropped from. Hold on. Did it drop from
4 to 269 basically? Yeah.
Yeah, it dropped from 4% to 2.69%, going from a pool fixed fee of 50 to 500. So that it is congruent with what I did on the calculator.
Yes, but I have to say that it's also dependent on the size of the pool, right? While the hit is really high on the bottom sides of the pools, it basically gets muted as your pool grows, right? And again, that has to do something with the fact that you're distributing this 500 over a larger amount of ADA holders, right? So 500 divided by 2 million is a larger portion of returns, basically, rather than 500 divided by 195 million.
Yeah.
So
I also saw peak rewards at about 95% of saturation.
Yes, there is the formula itself basically is so for every marginal pledge that you put, there is a peak return, right? So there's so at some point you do not want to put the extra ADA into a pool to fully saturate it, even though you get a lot of you get maximum returns at saturation point. But somewhere I think here at 146, 137, around 75% capacity, you get the maximum return for your pledge, which means that if you have 209 million, you're better off filling up the first pool with up to 75% and then giving the rest to another pool, because you will earn more on your ADA. So that, I don't know if that answers the question. So
no, that sounds good. Yeah. I mean, you get optimal zones somewhere between 75%, 95%. You got to run the math to do it. One thing I was just kind of disappointed in is that the A 0.3 did not allow pledge to provide much Sybil attack resistance. I don't know how important Sybil attacks are. I don't even know if they matter. But it didn't seem to do much. It really didn't. I ran a pledge of, for example, I ran a 50,000 pledge and a 5,000 pledge. Didn't seem to make a difference. What do you think about that?
Yeah. So the thing is that because
It didn't help the delegators. It didn't provide any more money to the delegators. It didn't seem to help the pool operator.
Yeah, so
Negligible.
the lower amount of a zero, which is the pledge influence factor, if that is lower, then you don't get as much sort of difference between a fully pledged and a no pledged pool. But that being said, it's also a function of K, because, for instance, I may just give you an example here. I'm going to set this back to 340. Let's look at this table over here, right? Because it looks at the desired number of pools and pool size as a function of annual delegator returns. And this is the delegator returns, the stuff that you get, at the end of the day, given the pool has a pledge of 100,000 ADA and the fee is 5%. So the maximum return, given these, parameters, I mean, I can lower it to 1% if that makes people happy. The maximum return you will get, it's calculating again.
There it goes.
Yeah, it was 441 with 5%. It's 460 with 1%, right? So that's not a whole lot of difference, but nevertheless. So what happens when you increase the K is the maximum return migrates towards smaller and smaller pools. So if you have a pledge of sort of a smaller pledge, then you are more likely to get that maximum return. So that's the effect of K on your returns. Now the pledge itself regulates the steepness of the slope between the high and the low no pledge. This is basically the difference between a maximum pledge and no pledge, and that's 1.4. If let's say the pledge that A0 was at 5, we could have seen a number like probably in the 5 or 10 or something like that. And that would make sure that these guys don't get any rewards, or they will get a very minimum rewards. And as soon as you start pledging, you will see a spike in the rewards. So since we have it set at 0.3, and that's I'll trust the scientists that have done this because they've ran simulations and they have introduced the minimum pool cost as a way to increase Sybil attacks. Then if that makes sense, then it would make sense. If it doesn't, I'm sure we will change that. I think it's not cast in stone as far as I know.
Yeah.
So yeah.
Yeah, it's up for community vote. I'm checking
Yeah.
chat for questions. Philippe, you got any questions?
Yeah, no, I mean, I agree with you, Rick. I mean, the A0 and K factor, they don't incentivize pool operators to pledge a lot, and they don't do much for the delegators. Both. I mean, I was running numbers, if a pool operator pledges 100,000 and has a delegator that has 100,000 pledged to that, delegated to that particular pool, and if they up their pledge from 100K to a million or a million to 10 million, it changes the percentage, the ROS, by a few thousandths of a percent. So meaning that 100K delegation may earn you like 3 or 4 ADA extra per year, depending on your pledge, which is a little bit concerning because as the price of ADA goes up, what's going to happen is that you have a lot of pledge operators that are just going to jump ship because they're not getting the returns that they should be getting. So why would you treat them as a pool operator when they can just make more money as a investor or speculator? I mean, they're not going to miss the next bull run if there's no incentive, if there's only a few hundred or a few thousandths of a percent increase on their bottom line. So that's going to lead to a lot of ADA being washed between pools, and people are trying to just set it and forget it. But I worry, my concern is that once you find a pool, is that pool going to be reliable for a longer period of time just because of the returns that the actual pool operator is getting for running that pool?
Yeah, that actually brings me to a very important, sort of finding that I have here. and that is there is a a minimum size pool that you have to have in order to be able to mint a block, right? And if I'm a delegator, I'm just putting myself in the shoes of a delegator, right? And I see two pools, right? Both of them have 2 million. One has a 2 million pledge and the other has 2 million in delegation, right?
Yeah.
So question is, are they equivalent? I mean, I'm asking you guys, what would you think? One has 2 million pledge and the other has, 100,000 pledge and 1.9 million in delegation. Which one of them is more desirable for you guys?
Well, I would reckon it's the one with 2 million, but that's not the case. It would be
They're both 2 million, right? In terms of
Yeah.
total size. But
You're
one has a
taking-
2 million pledged and there's no other delegation. And the other has 100,000 pledged, but 1.2 delegated. So pool sizes are the same. Which one is the most desirable for you guys?
I mean, according to Return ROS, you'd have I believe that the one that actually has the 2 million pledge would be slightly more desirable, but not to the degree of actually locking up 2 million ADA. That's a whole nother argument.
Okay, that's
Yeah.
true. But for me, if I were to make that choice, I would go with the pledge, and not because of returns. Returns are important, and I understand that in very small sort of increments of 1 or 2 million under the K of 150, that's not going to make a lot of difference. But when we get to 1,000, it will. But regardless, if I am thinking about a pledge, I'm thinking about stability, because imagine you're putting your money in a 2 million pledged pool. I can logically think that this guy is either put his own money or has an agreement for 1 or 2 years to keep that money there.
How much do you
What does
lose
that-
when they switch?
I agree with you, Matt. Do me a favor, go ahead and drop the screen share for a minute, and we'll go over to James's question. And I also want to follow up, not the X, just hit the green above the green. There you go.
Yeah.
And James, what was your question? Then I'm going to roll over to the chat, and then we're going to tie back into what you made with Son. What was your question, James?
So how much do you lose when you switch? Because if you switch pools, you lose out on your rewards for the epic, right? So
No,
No,
you don't.
You do
they're
not.
all seamless. It's basically you just switch from one pool to another. There is a lag between them, but the switching itself actually, unless you want to take into consideration the transaction costs, which are very minimal,
Yeah.
the switching isn't expensive.
Yeah, it only cost you 0.4 ADA, at least off the ITN it did. And then, you continue getting the rewards for the next 2 epics. So if I switch this epic now, I will get my rewards for this epic. I will also get my rewards from that pool the next epic. Then the second epic from today, which will be 5 days on the mainnet, the second epic from today, then I will get the new pool rewards. I will never lose continuity in rewards. Now, I do want to hit one question, then we're going to roll over to scams shortly if you guys are okay with that. And there's a persisting question in chat from Wonder Sound Radio where he says, why are pools ripping people off of their ADA if the protocol, or ripping out their ADA? But I know what you mean. If the protocol already awards the pool operators with so much ADA, dude, if you want these do you want a network? There's a better question.
Yeah.
What would happen if there was no reward for the pool operators? What would happen?
Yeah. Can I take that question?
Yes, sir. Take
go
it,
for it.
please.
Look, the question is very simple, right? Let's say that we had no minimums, right? And then pool operators were whoever is giving you the cheapest option wins because he gives you the most ROS, right? So what's going to happen to the network? So the first order of thinking for any any delegator is like, oh, that's great. I'm going to get great returns, right? But then you have to think about what kind of infrastructure that's going to run on, right? My take is that it's going to be just one guy running everything on VPS. And tomorrow, and James can probably chime in on that, if something were to hit AWS or DigitalOcean or whoever, then the entire network is going to go down because it's just one guy running like 1,000 pools at 0%. And yeah, you could buy a VPS for $6 per month, but that's not the point of decentralization. That's A. And B is that minimum returns attract people who have other opportunities. From a financial point of view, I can go and do other things with my time. And if I really love Cardano, I'm doing it for other reasons than money. But if there are developers out there who say, hey, Umed, I really like Cardano. It's just that I need to feed my family. And, if I can't do that, then I cannot be part of this, community. And so minimum rewards, they raise the bar and they attract people with brains that will actually grow this ecosystem. If you just put everything at zero and give everything to the delegators, then it's basically shooting yourself in the foot, because that network isn't gonna, develop that far.
You're gonna lose money. I'm sorry.
Eventually, you're gonna lose money because that network is gonna be useless.
Right.
Completely useless. Pool tool guy, Mike, I really love that guy. He's doing all of this that for us, at his own dime, at his own time. There are many other pool operators. Kyle, he's developing something, Adosia, the frog pool. And there are people who are attracted to the ecosystem, but we need to give them some sort of, I'm not saying that makes them rich, like $1 million rewards or whatnot, but you have to have some sort of a floor to make sure that these guys are attracted to the system and their time is kind of, paid for.
It takes time to set up a pool, and it takes even more time to set it up so that it will consistently operate and continue to make blocks. Because if somebody's being really slipshod about it, they'll fail to make a bunch of blocks, and then you'll lose money on that.
Yeah.
And it's going to take time. For the first 6 months of the Haskell is the same thing as the Jormungandr Rust network, and that is for the next year. There is going to be revision after revision after revision with new technologies being added, and the pool operators got to stay on top of that. They got to stay on top of the A factors. They got to do their reading. So I'm not putting in the plug for the pool operators. This episode was more about looking at it through the eyes of a staker. But if someone wants to call pool operators greedy, it's all about greed. I mean, there is a delegator greed, and it's competing with pool operator greed, and the pool operators have to stay on their best game, which takes time, in order to provide the best network to the delegators, and that's all there is to it. If you want a delegator run by exchanges like Coinbase or run by Binance, if that's the kind of network you want, go buy EOS. You don't need Cardano. Just go do EOS. Just whatever, And plus, you get in Cardano. Here's what I saw. Here's what I've seen over the 6 months of ITN. Very proficient pool operators. I estimate between 500 and 600 proficient pool operators. That's a fair estimate. That's not BS. That's a fair estimate. 500 to 600 proficient operators. At any given time, we had 288 block producers. We had over 1,000 registered. I think it hit 1,100 registered pools, but the actual functioning, responding pools was well over 500 pools in operation. Even if they weren't making blocks, they were still running those nodes. That's a solid network. Those people deserve some compensation for their time and efforts.
Yes, and another thing I wanted to tell, because I worked in emerging markets. I worked in markets where Charles goes and talks to the governments. And if you subscribe to the idea that this network is going to be the financial backbone for the world, for the developing countries and everybody else, you got to ask yourself a question, right? So let's say that Charles goes to Republic of Mongolia and say, we can put a stock market on you guys, create a stock market, create an exchange, et cetera, et cetera. And at some point, somebody's going to ask, like, what kind of infrastructure is this? Is your a network running on, right?
Yeah.
And if the answer is like, it's a bunch of exchanges and cheap VPSs, but nobody's going to be there. Nobody's going to come and say, okay, well, I'm going to just put my entire financial system on that. So you have to have a diversity, geographic diversity, talent diversity, different kind of pool operators,
infrastructure diversity between bare metal, hosted hardware, and cloud service. That makes it stronger. You got to have a really widespread rock pies, high end on the cloud. It's great. It's great. That's a very broad capability. Hey, I want to hit on one more question here, and then we'll roll over to scams. Sound good?
Yep.
You guys ready for that?
Sounds good.
All right. So there was a question in chat. Hold on. Let's see. What was it? So what stops a whale from running a pool? The answer is nothing. I hope they do.
Skills.
If there's a whale out there that has 100 million ADA, I highly encourage that whale to set up a pool.
Yeah.
And
see how it
they could do 100 million ADA in their own private pool, set it to 100%, and do well. And they could do well. I'm not going to give financial advice. I'm not qualified. I highly encourage them to do it. It will secure the network. If there's a whale that's willing to run a pool and pledge high amounts of ADA, go for it. Secure the network. That's what it does, right?
Can I make a comment about whales and time? So let's talk about whales. They own a large percentage of said cryptocurrency. So you have an ADA whale that may own 10 million, 15 million, 100 million ADA, whatever the case may be. So we can assume that they're very wealthy and doing well in life. Mm-hmm. Those kind of people, I'm not going to make a generalization and say all, but those kind of people, they're not spending time in the trenches getting a node up. That's why there's Coinbase custody solution. All the whales use Coinbase custody in order to stake or use it for their mutual fund or whatever products that they're offering. There are services for the very wealthy in order to help them get returns for their clients. They're not doing it on their own because they're spending their time working on all their different businesses. For people like that are within the ecosystem, that are within the ITN, a lot of them, they're spending a lot of time and energy within the protocol, understanding it. And I'm sure there are whales out there that may be spending a lot of time learning how to run a node, but for the majority, I feel like they're going to be using alternative solutions. And I don't know if anyone wants to speak to that, but that's my general understanding of that.
Knowing and working with very wealthy people, I can guarantee, well, I cannot guarantee anything, but I can see that a normal wealthy guy who's gotten to wherever he is by being very smart about his money, they will diversify the risk. They're not going to put everything in Coinbase. If I have let's say 200 million ADA, right? I'm going to divide it up. I'm going to put some portion in Coinbase. That's fine. The act of pledging or delegation does not require that you give up your keys. So you can basically put that, divide it into very small chunks, put it in different geographies, different infrastructure, and that will make the ecosystem stronger. And that's one of the game theoretic sort of upsides of this system is that, the larger holders of ADA are interested in diversifying their portfolio in terms of risk. Because if, let's say that one of the nodes is down, right? If all of your 200 mil was in that node, mm-hmm. then you just lose a big chunk of money for that epoch, right? You're not going to lose your principal. That's already safe, but you're going to lose on rewards. So the best thing to do is just basically divide it up, different geographies, different infrastructure, and do it that way.
Yeah, spread it out across a bunch of pools, and you've diversified your risk across those different pool operators.
Yeah.
Yeah. And you know what I like, what you just said, Umed? Although some people think 5% isn't much, what you said is very important because it can't go down. It can only go up. There's people out there betting on 5% investments in the world who run the risk of losing their initial. Like they put in $100 and now they only have $90. That won't happen in Cardano. It'll only go up. All right, we're going to switch over to scam shortly, guys. So, all right, thank you, Umed. Awesome, man. And we're going to be doing, Philippe, we got to hit this episode 98.
Yeah.
Episode 100 is going to be right about at the launch. We got to time that, all right, man?
Yeah, okay, sounds good.
So here's the timeline, and then we're going to switch into scams, and primarily we're going to lead off with James there because James is a cybersecurity professional, and he understands social engineering. That's what's been happening lately. But here's the timeline coming up for the next week. We're ready for launch. We are going for number 1. We are ready for launch at Cardano. The hard fork is July 29th. Right after July 29th, pool operators can begin registering their pools. Now here's the timeline as best as I understand it. Epic Zero, July 29 to August 3rd, approximately. Epic Zero might not start to August 3rd, but bear with me. Anticipate Epic Zero, July 29 to August 3rd. Epic 1, August 3rd to August 8th. That gives the pool operators time to bring those pools up online. Epic 2, August 8 to August 13, which allows those pools that are online to begin delegation process. Epic 3, August 13 to August 18. The pools are up and delegated to. August 18th onward, rewards begin. We are ready for launch. And then what will happen is on August 18th, D equals 1, which means it's not decentralized. The nodes are up, they're delegated to, and then D equals 1 begins the countdown to 0, and it should count down to 0 approximately around the end of September, or maybe a little bit beyond that. But as it begins to count down, you'll see the rewards start to come in, and the network will gradually decentralize. Cool? You guys good with that? Countdown to launch.
Sounds good.
We are clear for launch, guys. We are clear for launch.
Hi.
We ain't boo. Yeah, I was about to swear. All right. Philippe, with these scams.
Yeah. Oh,
What
my
happened
goodness.
last week with Twitter? What happened to YouTube? James. Why? Why are there scammers? Why is there scammers?
Because they think it's easier to make money scamming people than getting a job, I guess.
Do they win sometimes?
Yeah, sometimes.
Would you
Sometimes.
consider what happened on Twitter a win? Knowing how much BTC they came?
What did they get? 12.6, 12.9?
I didn't check the addresses recently, but they had it was close to 13 BTC. I mean, that's a decent chunk of change, but I mean, for some people that's worth it. I wouldn't personally risk it because the chance of going to jail, especially being in the same country as Twitter and everything, is a little too high for that. But,
Yeah. But why do people do it? Do people fall for scams? Is that why the scammers do it?
I mean, so in this case, this particular situation is a little unique because it was more targeted. In general, these scams, you see them all the time. It's just that they tend to get knocked down. So like if you follow Elon Musk, you'll see a tweet that looks like it's from him. And those are just kind of like broad blanket types of scams where people like take over accounts and rename the account, or they take over a YouTube channel and rename that, put up some content that makes people think that, they're going to get some money if they send some money to them. It's really no different than, the old scams, like where somebody, from Nigeria would send you an email and you end up in your spam folder. This particular Twitter one, though, kind of revealed a little bit more. The messages were coming from the actual real accounts that people were following. So they had more trust in that account. That's one thing I'll talk about sometimes is you have to be only suspicious when it comes to dealing with your money. Is you may think you're talking to the right person. You may have actually made a phone call and called your bank, but there still could have been somebody that, compromised that bank's lines, for example. In this case, Elon Musk was tweeting out, the scam directly. If somebody's gullible enough, they'll fall for it. And I shouldn't have used the word gullible. It's just like a lot of people don't really understand how these things work. I saw where people were posting up screenshots from their Coinbase account. when they sent that money out from their Coinbase, even if it was legit, he wouldn't have been able to send the money back, because it would have just gone to some Coinbase address and not to the individual crypto account on Coinbase. But I guess the rule is really simple. You're never going to get something for free. When it comes to this sort of thing, you never send anybody your crypto expecting to get a return back like that. That's one of the beautiful things about Cardano is you're never trusting anybody else with your cryptocurrency. Like when you stake, you're not giving the money to them. Like I have some Bitcoin miners that I was running like last winter to heat my house, but I had to trust the pool that I was mining with that they would actually send me the money, and have to do a withdrawal request. I had to trust them for that. So I chose a pool that I felt was reputable enough, but they could have decided not to send me the money. At least with Cardano, you don't risk that. So with Cardano, you never ever give anybody your keys. You never give them your seed words, and always be suspicious.
Send your ADA, right?
What's that?
You never send your ADA.
Yeah, well, I mean,
never send
if you're buying something, you'll send it, but yeah.
But you don't have to send it to a pool operator.
Right. Yeah. You never send it to a pool operator. If anybody's asking you to send them some crypto and you weren't expecting that transaction, then put some serious doubt on what's going on, because these scams are numerous. The scammers, they refine their game, and they get to be pretty good at it. They try to find ways of being convincing, and I'll see scams pop up where people are saying that they just want to be able to do a transaction. They want somebody to broker a transaction for them, that sort of thing. It's all sorts of complicated ways that they'll try to catch people up, where they send some, get you to send some money, and then they keep it. Yeah. You never hear from them again.
They'll use like charities. They'll say, hey, this is for charity or something like that. Nope, sorry, not sending it. Don't know who you are, not happening. Mm-hmm. Even if I agree with the charity. So how could they penetrate Twitter to such a broad degree? Was this a social engineering attack? Was this a backdoor? Was it an inside job? Was it a combination of two? What do you think? Just kind of speculate. I mean, what do we think this is?
Twitter said it was a social engineering attack. They said that some of their employees were targeted, ones that had more privileged access on the system, and I'm assuming that they got them to change the email addresses off of the accounts, because they did password resets, and the accounts that had two-factor authentication apparently were not compromised. So that just goes to show that two factors, even more valuable, because the Twitter employees were able to, I believe, just change the email address, but they couldn't change the two-factor. It's interesting that Donald Trump wasn't compromised, but I believe I know the reason why is a Twitter contractor deleted his account a couple of years ago. And so I believe they just put additional protections on his account to keep any rogue employees or contractors from deleting Donald Trump's account. So because of the additional protections, that's why he didn't tweet out any Twitter scams.
Oh, I thought Elon Musk was a Dogecoin fan now. So that wasn't real? I don't know if it was real or not.
That was real.
That was real?
That was real. Yeah. At one point he was made like CEO or something. I don't know. I can't remember.
Honorary CEO or something.
Yeah, it's kind of.
So what happened with YouTube? Let's kind of walk through that for a minute. We don't know what happened with YouTube, but YouTube had a bunch of scam. It's still going on now. There's people in chat reporting they're still seeing these YouTube scams all over YouTube. Is this a hack? Is this a coordinated effort? What do we think's going on there?
It's just a compromise of an account. It's like you can get online and get password lists, of email addresses matched up with passwords. You try those, you'll end up with somebody's account. I saw one where it was running a video of Charles doing a whiteboard presentation, and it says some little message about rewarding our community or whatever. Send some ADA to this address, and we'll send you back twice as much. And it looked pretty good. But if you went to the about page, you saw that it was some kind of a lifestyle blogger from Indonesia or something. The one I was looking at, and it's just somebody got that guy's password and to his Google account, changed his changed his YouTube channel and started broadcasting. And of course, then Google was actually, or YouTube was actually showing it in the list of recommended feeds. It was like the next up was some scam, but it's just, they just compromise somebody's account and just change the content to match and then start running a live stream.
And they're paying for ads too. So in before videos, I saw a couple of them. I saw one with Vitalik doing some kind of speech, and
I wouldn't be surprised if somebody's paying for ads. They're actually paying for the ads off of somebody's stolen account. So they're probably not even paying for the ads themselves. They're probably taking somebody else's money. Because if you get a hold of the passwords to somebody's account, then some people will have their Google accounts hooked up to pay for ads. So it's kind of a lucky score on the scammer's part, and they take advantage of it.
I always wonder, how do people fall for scams? If some person came up to you on the street and said, "Hey, you give me $1 today and I'll give you $2 back tomorrow," would you believe that?
No. Well, I mean, people like to be helpful. And so I do a lot of social engineering, a lot of hacking type things on contract. Companies will say, "Hey, we need somebody to try to break our security." We give it a go. And I have a 100% success rate with social engineering.
What?
Every single company I've ever been asked to hack, I get them through social engineering.
Holy dude. A 100% success rate on social engineering.
Yeah, well, because there's always somebody who wants to be helpful. I told you before, there was a company that hired me to do penetration testing. They wanted me to attack from, through the internet, and to check off the list, they wanted me to try to physically get into their facility, which was a nuke facility. It was very secure, armed guards and the whole bit. And they told me, "Don't worry about it. You're not going to be able to do it. But just try anyway, because we need to have somebody to try." And I did it.
Jesus.
And what I did was I just pretended like this is a very large entity. They have offices all over the place, all over the world. And I pretended like I was a new employee who was going to be starting in an office in a different state. So I was going to be moving, but I was going to be working with people locally. And I needed, my new soon-to-be boss, I should stop by and talk to these people. And the guy that I asked to meet with, according to his Facebook, was at a wedding. So he wasn't there. So I was asking for a guy that wasn't there, but I was asking for a guy by name. And so I'm talking to the security guy, and he's trying to call and he can't get him to answer. But he's trying to be helpful because he thinks I'm somebody who's going to be, somebody's going to be around a lot in the future. So he starts calling around, trying to find anybody who wants to bring me up there and show me around. And somebody said, "Yeah, I'll meet the new guy." And
Jesus.
next thing you know, I'm on the inside.
Oh my God, dude.
Oh.
Wow. I can't say I'm invulnerable to that. You're right. People do want to be helpful, and you just use that against them.
Mm-hmm.
It's not gullible. It's not stupid. You can take a perfectly intelligent, reasonable, skeptical person, and you can play on their ability to want to help. And
their willingness to help, their compassion. I mean, you're talking about the guy on the street. If he says, "Hey, give me $1, I'll give you $2 tomorrow." I mean, somebody might be like, "Well, this guy's having a hard time. Maybe he won't be able to pay me back," but they'll give him the $1. I mean, technically, I fell for something similar to that when I was 18. I had just moved to a larger city. There was a guy that was giving me some long story about how I ran out of gas and all this, and just needed a couple bucks for gas. So I gave him a $20 bill. It's like, whatever, and an hour later, I see him walking around still asking people for money. It's like, oh man,
yeah. I noticed that the one where, "Hey, I need to get a bus ticket to get back to Ohio or San Francisco or something like that," and they're doing it in a Walmart parking lot, and then you see that guy 2 days later, and they're still saying, "I need some money to get back to Ohio." I'm like, dude.
Yeah, he kind of drained out some of my generosity.
I think we need to distinguish that, like, goodwill from these scams of people trying to multiply their wealth within fractions of time. I know it's very evident within crypto because everyone's after those fast returns, those fast gains, especially how crypto prices fluctuate. But people are looking to get rich, not necessarily helping the counterparty build up their wallet.
That's the current scam right now, but eventually that might play out. Then they'll start resorting to other types of, more sophisticated ways of tricking people. It's like, if anybody says, send me some crypto and I'll see you twice back, that's a scam. But when that stops working, and eventually it'll stop working because eventually everybody will learn, then they'll try something else that'll somehow try to play on goodwill somehow. You go back to the guy saying he needs some money for his bus ticket.
Yeah.
So James, I had
go ahead, you meant.
Yeah, something that popped into my mind, James. Do you have any statistics about these scams, whether they're more successful in countries that are not sort of, democratic or English speaking or not? Because, if you're growing up in a country that has a completely different economic and political structure, then you would believe anything. You'd say, okay, maybe it happens in America, because it's a capitalist sort of society, these kind of returns are normal. So maybe, and you don't have the ability to verify that because you don't speak English. So if somebody comes into you, puts the video of Charles Hoskinson and just tells you anything, that kind of creates I think, legitimacy in a way. I don't know.
I think you're probably right. I mean, I don't know, the percentages of, who's getting scammed, but based on responses that I've seen, where somebody says, "Where's my money?" It does seem like they're probably English second language, but I don't know for sure where they're all coming from.
Because the reason I'm saying is that up until 18, I had no idea how capitalist economies worked, right? I grew up in Soviet Union where you would just go to the store, you have two types of bread, two types of milk, and half the time it's not available even. But the thing is that if somebody came, and early in the days when the Soviet Union fell apart, there were a lot of scams. There were scams like, oh, give me the money and I'll multiply it, by 500. And these were pyramid schemes, right? And for some reason, it was all televised on a national television. Really, I used to think that, okay, maybe that was the capitalism. Maybe they have a scheme that works that I don't understand, but, lots of people lost their money, and they were advertising, there was one famous one, Triple M, that would tell you that, the janitor would basically say, oh, I put 50 rubles and, 5 days later I got 500, and I'm putting that all back in, something like that.
We have that in America too. No, we do. I mean, there's there's definitely pyramid schemes where, that are kind of come and go. And there's some that are really long lasting, and they might not like, people that are involved in it might not like it if I call it a pyramid scheme, but Mary Kay is like a makeup, Amway and so forth. The people at the top make some money, but most of the people are at the bottom just paid some money to be able to buy the product for themselves. And they don't really, they spend a lot of time trying to sell something they don't make a whole lot of profit on. I mean, so those technically are not illegal because they're actually selling a real product, but they just end up buying it for themselves to meet their numbers. But the way people get roped into those things is they get these promises of great rewards. If they can get, 50 of their friends to all buy this product and sign up 50 other people underneath them, then they're gonna be wealthy. And it doesn't usually work out that way. You just kind of wear your friends kind of thin, asking them to sign up for it.
Mm-hmm. There's pass-through scams where they just take a product and resell it at 1,000% markup, and you're just getting the same thing you could have got cheaper. They used to do that with books, encyclopedias. I saw those a lot. Encyclopedias, basically anything that we normally buy today that you buy on the internet like eBay and Amazon. Those things used to be sold via TV and other mechanisms. So, how do we protect ourselves from scams? What should people be looking out for? Basically, the something for nothing, or what do we do?
You have to kind of try to get control of your greed, your greed, or your. Greed's not the only way. like for example, people get on dating websites and they encounter scammers. Like the majority of the accounts on like Tinder, for example, are scammers. There's somebody who, there's probably a bot creating the accounts, and then somebody responds. Some guy's like, "Hey, this woman actually says she actually swiped right on me." It's like, great, and there's like a slow conversation that builds up, and at some point she's going to ask, she either goes for, "Hey, can you sign up on this site because I have all my preferences on this site that you have to pay for," and she's just trying to get a commission, which is actually not a she, it's just some guy somewhere who's like trying to get affiliate referral money, or it could go as far as where some guy is pretending like he's some woman and she needs a plane ticket. Send me some money so I can have a plane ticket to come see you, because I don't have the money to get out of my country.
Yeah. So it comes in all. So our willingness to help and our greed. If we understand ourselves better, use some thinking, and it's not common sense. Common sense is not that common. But if we apply some critical thinking to our own sense of greed and our own sense of our willingness to help, that might help us avoid scams. And plus, I like that simple version. I've seen a lot of people say it. If it looks too good to be true, it's not true.
Right.
Why would someone give you more money? Hey, give me $1, I'll give you $2 back. Doesn't make sense. Does not.
Right.
And there's the impersonation scams. That just happened to me yesterday. Someone on Coinbase tried to impersonate me. Can I screen share that real quick?
Yeah, see it.
Impersonation scams. All right, so someone created an account. They stole my data. This happens all the time. Let me see if I can throw that up there real quick. That other screen, pop that up. And so I don't know if you can see that. You see these two pictures? There's one on the left and one on the right. This is the scammer. They just took my name and my picture and everything on Keybase. My Keybase ID is Rick_McCracken, and they made one called Rick McCracken. Then they started following, over here you can see the followers. They started following people I know. Now, fortunately, those people very quickly reported it to me and said, "Hey, this guy isn't right." So what I did on Keybase is I just hit block and report. So first I hit report, harassment, and then block. Now this guy's pretty clever. This looks a whole lot like me. They took my picture off of social media. And then they were very honest and truthful. They said, "I make shitty YouTube videos." So that's a pretty accurate statement right there. And so that's pretty convincing right there. And then they could use that account to try to dupe people. And they're on Keybase, where you can very quickly send ADA, or not ADA, you could send Stellar on it. And someone just saying, "Hey, I'm doing a fundraiser for Suman G. Komen Race for the Cure. Can you send me any extra Stellar you got?" And then people start banging it out. It's right there. Just click, click, click. Bam, that Stellar's gone.
Yeah, it can be hard. People will go to those links. They don't even have to actually manually do it if they want to write, a script or program to start duplicating accounts. But before you send anybody money, try to actually talk to the person. I personally have talked to people who have sent tens of thousands of dollars because somebody they knew said that they were stranded overseas and needed some bail money or something, or needed, their wallet was stolen, passport. So they did wire the money because it's like, "Hey, this is somebody I know." So they send some money overseas, but there's actually just somebody that hacked into somebody's email account, sent their contacts a message saying, "Hey, I'm trapped." Well, they could have just tried to call the person. And sometimes I annoy my customers a little bit because I'll get a request saying, "Hey, can you do this or do that?" And I'll call them up and say, "Did you actually ask for this?" And they know why I'm asking, but if it's something that has any risk, pick up the phone and call the person, or get in contact with them directly in a way that you already know how to contact them. Don't just follow the link in an email. Don't follow the link in a tweet or, even, just try to get in contact with this person and make sure the response makes sense.
Yeah. And I call that positive confirmation that you know exactly who you're talking to, which you cannot do on social media. It's impossible. It doesn't matter if it's Facebook, Twitter, Telegram. You cannot get positive confirmation on social media. I've had people DM me and say, "Hey, I want to be a pledge supporter. I want to help you out. I want to provide pledge to raise the pledge on your pool," and I will not respond. I do not respond to that. I cannot do it. It is impossible. Because you cannot confirm who that is on what's going on. You cannot. Unless you have DNA evidence or physical face-to-face contact, ain't happening. Not going to happen. And anyone who does do it, good luck. It's high risk.
Yeah.
It's really high risk.
I mean, there's ways you can try to build rapport with somebody. The scammers generally, unless it's for a lot of money, are going to do more, blanket type attacks. Where they're sending out a lot of emails or throwing up a YouTube channel and trying to catch the followers of the person whose channel they stole or whatever. But they will, if there's enough money involved, they will go directly after somebody, spear phishing or whatever. It's like, I won't tell your secrets, Rick, but watch, I know why you had that curtain.
I know. Yeah, you sent me a picture one time that scared the shit out. No, it didn't scare me. I'm not scared. But he sent me a picture. I was like, holy shit, James, you are a hacker, man. Oh, he just sent me a picture. I'm like, damn, you got me. You got me.
Yes.
I'm glad you're a good guy. I hope you're a good guy.
Yeah.
We'll find out.
We'll find out.
I'm just kidding.
I'll find out.
You got to be careful about what kind of information you give out to people, because a lot of times people will take a little bit of information and then roll it into the next thing and then the next thing. It's like with Twitter. I don't know exactly what happened, but I can make some guesses. There were multiple systems that had to be compromised. So they would get maybe an employee's password, but then they would need something else, and then they would get that other thing from the other person. It's like if you start to build up a ball of information to the point where somebody feels like you are an insider, you are somebody who's supposed to be asking these questions. So it's like you have to be careful about what you give away. When a person is asking for something and you can't think of a valid reason why they really truly need it, then just don't give it to them. Somebody chatting with you on Twitter doesn't need your phone number, doesn't need your date of birth. I mean, people are going to be a little bit more hesitant to hand out like their date of birth, their social security number, that sort of thing, but they don't really need to know your kids' names. They don't need those little details, because next thing you know, you have somebody who claims to be calling from the school about a kid, and it's like, oh wow, okay, or it's like, hey, this is deputy whatever from the sheriff's department, we got your kid down here, and they had the kid's name and date of birth and everything, and it's like the more information you give away, the harder or the easier it is for the scammer to build something to go after you. But in general, the crypto scams are more blanket. They're not going after you individually, but if there's enough money involved, they will.
Okay.
Well,
I think that's
thanks
good.
for the insight.
Rick, we are at almost an hour and a half. We're approaching that. So I think we can wrap up this episode.
Yes, sir. I just
Sounds
checked
good.
our Reddit questions. We've got almost all of them answered. So thank you to our Reddit users. I can see we got your Bravo 001, Yoda Logical. Thank you for your inputs. Ada Toshi and Univocity. We got all of them answered except for one, and that was the question from Ada Toshi where the person asked, please discuss the tax implications of running a pool versus delegation for United States citizens. And I apologize, but we cannot get to that question on this episode. We can't do. I mean,
A tax lawyer.
Get yourself a CPA.
yeah, you'll have to talk to a tax lawyer. We can't do. It's too complicated. It's too complicated. You'll have to talk to someone who is in your area, city, state, and U.S. And understand the whole thing, because it varies from state to state.
Okay.
Even if we brought a tax professional on, it wouldn't probably wouldn't help much, because
If I
every
could-
state is different.
If I can make one statement about delegations and delegators, do not send, under any circumstances, do not send your ADA to a pool operator, no matter what they say. You don't need to send it to a pool operator to stake. So to delegate to stake, never ever do we need any, actual ADA from you guys.
Yeah.
Yes.
Maybe don't copy and paste any commands that anybody asks you to copy and paste to delegate or something. You just use the official interface for it.
Yes.
Yeah. And thank you for that, UMed. That's a great reminder.
Yes.
And also a reminder there is a snapshot this afternoon. It is not a reward snapshot. It is occurring at 0 midnight UTC, 2000 Eastern Standard Time. For reference, 2000 Eastern Standard Time, Sunday, 000 UTC. No rewards. That is for testing the mainnet candidate only. So we are clear for launch. We need to test that mainnet candidate. And once we get through those hurdles, we'll be ready to rock and roll.
Okay.
You guys ready to wrap it up?
Yes, sounds good. This was episode 98 of the Cardano Effect podcast. Please remember to like, comment, and share. We appreciate all your support. I want to thank Umed and James for showing up today. We always like having both of you on, so let's do it again in the future. And everyone, I hope everyone has a great weekend. Remember, there are a lot of news and events happening within Cardano. Take your time. Make sure you read through documentation, follow the correct accounts. There are going to be a lot of spoofed accounts. We don't know you. You don't know us personally. So let's keep it that way. Delegation, don't send your ADA. Watch out for scams. Everyone have a wonderful week. And until the next episode of the Cardano Effect. Bye, everyone.
Thank you.
Bye. Thanks. Take care.
Bye. Okay.